All right, let's talk about Blackstone. You know, the private markets titan. But here's the thing. The way most people think about this company, it's completely, and I mean completely out of date. We're going to fix that right now.
Let's just kick things off with this idea, because it is the absolute key to understanding the Blackstone of today. For years, yeah, you could just say private equity and you'd be pretty much on the money. But now, that's like calling an iPhone just a phone. It completely misses the bigger picture, the entire platform.
So on the left, you've got the old view a lot of people are still stuck on, the cyclical deal shop that only makes big money when it sells things. But the new reality, over on the right, is a totally different beast. It's a much more powerful three-layer financial platform that's built for durability, not just for riding the market highs.
So what is this three-layer machine anyway? Okay, let's break down the distinct engines that are actually powering the company today. This is the real core of the modern Blackstone story. You know, when you look at the company's history, you can see this was all very deliberate. It wasn't an accident. From its founding back in '85, it was about building a platform. Going public in '07 was a huge step, of course, but the real signal, the moment things really shifted, was in 2018 when John Gray, the guy who built their massive real estate empire, became president. Each step was about building something much, much bigger than a simple private equity shop.
Okay, now hold on. Before we go any further, you have to understand this concept, perpetual capital. And listen, this is not just some Wall Street jargon. This is the secret sauce. See, a normal fund has to give the money back after a few years. But this capital, it sticks around. It doesn't have an expiration date. And that gives Blackstone this incredibly stable, durable base of fees. It's a total game changer for the quality of the business.
This slide just breaks the whole thing down perfectly. Layer 1 is the anchor, right? That's the recurring management fees from all that capital. Super steady. Layer 2 is the classic model, earning carry, which is just their slice of the profits when they sell an investment. And layer 3? That's the future. It's this massive distribution platform built on insurance and private wealth, all fueled by that sticky perpetual capital we just talked about.
So, that's the theory. But does it actually play out in the real world? Let's dive into the company's 2025 financials, because they give us some pretty clear proof that this three-layer idea is for real. Let's start with just the sheer scale of this thing. By the end of 2025, Blackstone was managing a staggering $1.275 trillion in assets. Just let that sink in. This isn't some niche firm. This is one of the most important pools of capital in the entire global financial system. In this chart of where that money is, it really shows the shift we're talking about. Look at that pie. Private equity, at 33%, isn't even the biggest slice anymore. Credit and insurance has surged to become the largest segment. The business is just fundamentally more diverse than its old reputation would have you believe.
Now, for what I think is the single most important number to really get the quality of this business, it's 2025 fee-related earnings, or FRE. The easiest way to think about this is it's the highly profitable, recurring cash flow they get just from managing all that money before they sell a single thing.
And this visual just makes it undeniable. On the left, you've got that stable, recurring fee engine, the FRE, at over $5.7 billion. And on the right, you have the more volatile, cyclical realization engine at $2.8 billion. I mean, the reliable part of the business is now more than double the size of the lumpy, headline-grabbing part.
So what's the big takeaway here? The crucial point is that the entire foundation of the business has changed, fundamentally. Blackstone isn't a boat that just rises and falls with the deal market anymore. It's now anchored by this massive, durable, and most importantly, recurring earnings base. So this new structure brings up a really big question. How should we actually figure out what this company is worth? Because as you're about to see, the old ways just don't work anymore.
Yeah, you can't just slap a simple price-to-earnings ratio on it. It just doesn't cut it. Why not? Because you're trying to value three very different kinds of earning streams with one lazy number. You're mixing a stable, predictable business with a cyclical, bonus-like engine and a long-term growth story. It just makes no sense.
So serious analysts use a much smarter approach called sum of the parts. They value each piece separately. Bucket 1, that FRE machine, gets a high multiple, kind of like a software company. Bucket 2, the carry engine, gets a lower, more cyclical multiple. Then you add in Bucket 3, which is the value of all the investments sitting on their balance sheet. And finally, Bucket 4 gives them credit for that huge future growth option in distribution. It's really the only way to get a true picture of what it's worth.
So all of this, the evolution, the numbers, the way you value it, it brings us to the one central debate that every serious Blackstone investor has to face today. And this is it. This is the whole ballgame. Is Blackstone now a true, durable compounder that's just going to churn out reliable earnings growth year after year? Or is it still, at its heart, just a very high-quality cyclical company that needs a strong market to really perform? That is the real argument, and now you understand both sides of it.